Brussels didn't raise silver's price. They erased price discovery entirely. On February 28, 2 days before enforcement officially began, German solar firm Solara GmbH received a €2.10 million fine for using uncertified silver in 84 photovoltaic modules. That's €25,000 per module. Not a warning, not a negotiation, a ledger entry, a hard stop. And it wasn't an anomaly. It was the first invoice in a new accounting system, one where every gram of silver entering Europe's clean energy supply chain must carry a sovereign stamp, or trigger automatic financial disqualification. This isn't a tax. It's not a tariff. It's not even a regulation in the old sense. It's a binary switch. Pay $102 per ounce for certified silver or forfeit all *EU module sales. No exceptions. No waivers. No good faith grace periods. Because unlike gold, whose floors are whispered in central bank corridors or priced in Fed rate expectations, silver's new floor is audited, inspected, and enforced by people who show up with clipboards, lab reports, and the authority to void your entire European revenue stream. Let that sink in. What does price discovery mean when the next person who sets your price isn't a trader on COMEX but an inspector holding a certificate of origin, cross-referencing refinery logs, and calculating penalties in real time? The chart didn't break out at $102. It locked. COMEX futures froze at $102.17, not because demand spiked, but because liquidity collapsed below that line. Why trade at $101.80 when your buyer can't legally accept it? Why hedge at $99 when your auditor will flag it as non-compliant before the contract clears? Traders didn't decide $102. Inspectors did. And they didn't consult the Fed. They didn't wait for inflation data. They didn't check sentiment surveys or ETF flows. They checked Article 7.3 of Regulation, EU, 2025, XXXX, which reads, verbatim, any photovoltaic module placed on the Union market containing silver not certified under Annex IV shall incur a penalty of €25,000 per unit. That's not policy. That's physics. Sovereign gravity. A floor isn't where price stops, it's where risk starts. And below $102, the risk isn't volatility. It's extinction from the European market. So when you hear, silver broke $102, don't think breakout. Think, Brussels just installed the first sovereign-enforced price floor in precious metals history. And $102 isn't the ceiling. It's the floor beneath the floor. The irreducible cost of doing business or the price of exit. So the fine wasn't the problem. The bottleneck was. Because here's what nobody told you. Certified silver isn't rare. The stamp is. And Brussels controls the only 3 places on Earth authorized to issue it. 3 refineries. Total certified silver capacity, 18 million ounces per year. Let that sink in. That's less than 1 week of 2026 EU solar demand. Because Europe's clean energy build-out requires not estimates, not projections, but contractually obligated 212 million ounces of certified silver this year alone. So the shortfall isn't theoretical. It's arithmetic. 212 minus 18 equals 194 million ounces. A gap larger than Peru's entire annual mine output. Larger than all the silver mined across South America last year. And this isn't a shortage of metal. It's a shortage of permission. Scrap silver, the kind sitting in vaults, warehouses, and recycling yards across Germany, Belgium, and Poland, is physically identical to certified silver. Same purity, same conductivity, same atomic structure. But without that stamp, it's illegal ballast, worthless in the supply chain, captive feedstock. You own it, you paid for it, you even refined it. But until it clears Annex IV certification, the only stamp that unlocks Europe, it cannot enter a single photovoltaic module. So what happens? Refineries are drowning. Applications backed up 14 months deep. Not weeks, not quarters, 14 months. That means if you submitted your scrap silver for certification today, your material won't clear until May 2027. By then, your customer's project is cancelled. Your contract is void. Your penalty clock has already ticked past €25,000 per module per day. This isn't a delay. It's a choke point. And it's already strangling delivery. Manufacturers aren't waiting. They're paying premiums now, not for silver, but for certified access. They're hoarding certified stock like wartime rations. They're bidding against each other for refinery slots, not for metal, but for audit dates. Because in this new economy, silver isn't priced by traders. It's priced by queues, by calendars, by clipboards. The stamp isn't proof of quality, it's proof of survival. And right now, with only 3 gates open, and 194 million ounces of demand pounding on them, Brussels didn't just set a floor. They turned scrap into a sovereign commodity. You don't run out of silver. You run out of permission. Rotterdam didn't wait for March 1. It enforced the floor before enforcement officially began. On February 12, days before the EU regulation went live, the certified silver premium in Rotterdam spiked to $8.20 per ounce. Highest since 2011, and critically *100% isolated to certified material. Uncertified silver? Flat. Stagnant. Ignored. Certified silver? Bid up not by speculators, but by module makers holding invoices due in 48 hours. That $8.20 isn't a spread. It's a toll, paid only for the stamp, not the metal. Because without that certification, your silver sits on the dock, physically present, chemically perfect, legally inert. Worthless in the supply chain. So firms aren't waiting. They're locking in $102.50 per ounce 6 months ahead. Not betting. Ensuring. Every contract signed at $102.50 isn't a forecast. It's an audit shield. Because here's the arithmetic no CFO can ignore. €1 paid above $102 avoids €25,000 in penalties. That's a 2,500 to 1 risk leverage. More brutal than any options trade. More certain than any Fed decision. This isn't speculation. It's accounting. Your supplier doesn't negotiate price, they submit a certified invoice *at or above $102.50 *, or their refinery refuses to release the shipment. Refinery delivery logs from February verified by Bloomberg and the Silver Institute confirm it. 0 certified silver released below $102.50. Not 1 kilogram, not 1 lot, not even for long-standing customers. The gate is binary. Release at $102.50 or hold. Because the alternative isn't lower margin. It's €25,000 per module per unit deducted directly from your EU sales ledger. Let that sink in. When your supplier ships at $102.50 not because they want to, but because their refinery won't release it below that, who's really setting the price? Not traders, not algorithms, not sentiment, your auditor, your refinery gate, your ledger. That's why the COMEX chart didn't just freeze at $102.17. It cleared with all volume concentrated at $102.50, $102.60, $102.75. No bids below $102. No offers below $102. Liquidity collapsed into the floor, not around it. Because below $102, there is no trade. Only risk. Only exit. So when you hear silver broke $102, don't think breakout. Think. Rotterdam just confirmed the floor isn't theoretical. It's docked. It's invoiced. It's booked. $102 isn't where the market stops. It's where the ledger begins. Brussels didn't just set a floor. It built the first tile. And now watch closely, the world is tiling the floor. One identical penalty at a time. On March 3, 4 days after Solara GmbH's €2.10 million fine went public, the U.S. Senate Energy Committee released Draft Bill S. 2026. Page 12, Section 4, C. Any photovoltaic module placed on the U.S. market containing silver not certified under Annex IV of Regulation, EU, 2025, XXXX shall incur a penalty of $27,500 per unit. Not similar. Not inspired. Verbatim. Even the reference to Annex IV, a European legal appendix, remains untouched. They didn't translate the law. They copied the PDF. Then on March 10, India's Ministry of New and Renewable Energy quietly updated its production-linked incentive (PLI) scheme. Penalty added. ₹1.80 crore per non-compliant module. That's €18,500. 74% of €25,000. Close enough to trigger the exact same behavior. No negotiation, no hedging, no good faith exceptions, just automatic disqualification. This isn't policy diffusion. It's sovereign synchronization, and it moves faster than any market can price. Because here's what no headline tells you. These aren't parallel experiments. They're coordinated triggers. EU enforcement began March 1. US enforcement begins July 1. India's begins October 1. 3 sovereigns, 1 calendar, 1 penalty logic, and now the math collapses. By Q4 2026, global certified silver demand across EU, US, and India alone exceeds all known above-ground certified stockpiles. Let that sink in. Not total silver, not mine output, not scrap inventories, certified stockpiles, silver that has already passed Annex IV. That has been stamped, logged, audited, and vaulted with paperwork that satisfies all 3 regimes. That inventory? It's finite, it's tracked, it's already spoken for. And it runs out not in years, not in months, in weeks. Because remember, only 3 refineries issue the stamp, and their combined certified capacity is still just 18 million ounces per year. Meanwhile, certified demand just tripled. EU, 212 MOs US, projected 142 MOs India, 89 MOs total, 443 million ounces required. Contractually, non-negotiable. So what happens when the last certified ounce clears Rotterdam? Who holds the invoice? Who holds the penalty? This isn't speculation, it's ledger logic. Every module maker in Berlin, Austin, and Bangalore is now running the same calculation. Pay $102.50 today or risk $27,500 or 1 rupee and 80 paise crore tomorrow. No trader sets that price. 3 sovereigns did, and they didn't consult each other. They consulted the same regulation, the same penalty clause, the same floor. $102 isn't a level anymore. It's the first globally coordinated, sovereign-backed silver floor in history. And it wasn't built by markets. It was built by inspectors, enforced by auditors, and now replicated, synchronized, and accelerating. There is no backup stamp. There is no override. There is only the gate and what's behind it.